In this video, I'll be talking about something that I use quite a bit as a guide as to which direction to look in the market. Now, most of you probably have been exposed to technical analysis. For example, buying a pullback at the 50% Fibonacci retracement level that bounces. But the reality is that the market moves on more than mere candlesticks. If that was the case, it would be extraordinarily easy, and large firms wouldn't pump millions of dollars into research. So you also have to have the idea of why the market may move. And generally speaking, I try to look for some type of fundamental reason for a market to make a move, and then a technical analysis setup that I believe jives well with it. For example, if a certain thing happens, maybe geopolitically, then I look for a setup that goes with whatever that geopolitical risk on or risk off event happens to be. So a quick example might be something like new war, some type of conflict brews. A lot of times, certain things like the US dollar and the Swiss franc, maybe gold will find a little bit of a bid. It's not an exact science, but over the longer term, it gives you an idea at least where to look in the market for your setups. So I take the reasoning, the fundamental reason, and then look for the technical setup. And if they line up in the same direction, I generally will take the trade. In this video, I'm going to talk about something very easy that I use all the time for decisions in the metal market. So, for example, silver and gold. It isn't the be-all, catch-all, 100% perfect trade setup, but what I have found is basically if you pay attention to the US dollar, interest rates in the United States, it can give you a bit of a heads up as to what's going on with gold and silver. Ultimately, this just gives me an idea of what direction to look for as far as a trade setup is concerned. Okay, so the chart in front of you is at tradingview.com. It's a free website where you can get pretty decent charting, and I use it a lot to monitor a lot of different markets. In this case, I have the 10-year yield in front of you from the United States. That is a big driver of a lot of things, including the strength of the US dollar. In this case, US 10Y, which is the symbol for the 10-year yield, rises. Generally speaking, the US dollar will rise. And the reason for that, of course, is you can make more money by holding bonds. The interest rate works out in your favor. So you can see that during the year 2022, 2023, 2024, we had seen the yield rise, and subsequently, I can go ahead and compare this to the Dixie. So the Dixie, DXY, is the US dollar. And you'll see on the chart, it tracks pretty closely. The candlesticks are the 10-year yield. It rises, the dollar rises with it. Now, it's not tick for tick. It's not perfect, but it gives you a directionality. Notice as yields fell, the US dollar fell. Now, the US dollar index is a measure of the US dollar against multiple currencies, so it's like an overall generic look at the US dollar. So you can see that you can more or less use either one. So what I will do, then I will show you that the 10-year yield and gold and silver have what is known as a negative correlation. 10-year yield up, US dollar up generally. Most of the time, if the yield's up, gold's down. And the reason is you have to understand that large amounts of money go into these markets. And in order to truly hold physical gold, these large funds have to pay storage fees. So holding gold pays no interest and it costs money. So if yields rise, typically they would rather hold US treasuries because it's a piece of paper, or really these days it's just an electronic transaction. So let me go ahead and add, in this case, let's start with gold. And I'll click on new price scale on the chart. And you'll notice that it's not always the case, but notice how the 10-year yield was rising in August of 2022 all the way to October of 2022, and gold was falling. Notice, though, that a lot of times the inflection point will lead or lag each other. So, for example, notice that the gold market had been right around the $2,100 level, kind of stagnant, and then shot straight up in the air, and they both went up at the same time. But once yields started to fall in the United States in the 10-year yield, at that point, we've seen gold go somewhat parabolic. So let me go ahead and get rid of gold, and I will add silver. Silver, again, you can see that as yields dropped, silver skyrocketed. Now, granted, that's a pretty extreme move, but notice how silver was dropping a bit while yields were rising. And then there was an inflection point where silver really tanked down to about $18.25. And at that point in time, yields were at about 3.55 and climbing. You can see that the silver market, like the gold market, led the 10-year yield as it rose. Silver was rising a bit, got a little noisy, and then once that 10-year yield started falling, silver took off. Now, something to keep in mind about silver is it doesn't have the same purpose that the gold market does. A lot of people make a huge mistake of assuming that gold and silver are the same thing, and they really aren't. They're not even close sometimes. So notice US dollar kind of range bound here for most of 2022 to midpoint in 2024 as I record this. Let me go ahead and put gold on again. And as I zoom out, you can see, for example, the US dollar index skyrocketing, gold plummeting. Gold turns around, all of a sudden we see the US dollar index fall. So generally what I'll do is I'll look at these factors, and there are other ones obviously, and there are times when gold and the US dollar can rise at the same time. That's generally some type of panic. The US dollar is considered to be a safety currency. So, for example, you can see the US dollar strengthen quite drastically because there's a rush into the treasury markets. Generally speaking, you'll understand why. For example, an extreme example might be September 11th, 2001. In that time frame, you had seen gold and the US dollar skyrocket for safety, mainly because nobody knew what was going to happen. They didn't know how big this was going to be, etc. There are other things that move the metals markets, but this is probably the easiest and the most visual way to really get a look at it. Nothing's perfect, so generally speaking, what I would do is I would take, for example, the chart that we have right here. It is a weekly time frame, just to kind of zoom out. But at the 100 level, we see some support for the US dollar index. If it breaks through there, I imagine gold will truly take off at that point, even though it's already at $2,650. If it bounces, and it, from a technical analysis standpoint, looks like it very well could, the US dollar that is, we might see a bit of a pullback in gold. So, for example, if you already own gold, you might be looking at this and going, it might be time to take profit. So these are a couple of tricks that I use with the 10-year yield, the US dollar index, and the negative correlation of both gold and silver.